Are you currently using indicators in your trading and you're struggling? Do your charts look like this? Are you having success with indicators? Do you even need indicators at all to trade? How would you like your charts to look like this? Clean, naked chart setup every single time. Let me show you right now in the next 10 minutes why I believe this is the best way to trade. And then you can make your decision after that. Let's rock and roll. Okay, Clifford, the 25-year trader, back with another video. So today, we're going to talk about indicators and should we be using them in our trading at all? Now, there's a lot of different, opinions about this out there. Some people praise indicators, some people hate indicators. I was the one that when I was new to trading, I used to love indicators. I love them so much. I bought every freaking system that money could buy for indicators. I was new to trading. I didn't understand price action at all. And I was just buying system after system after system, wasted thousands of dollars probably on sniper indicator, dead zone indicator, this indicator, 90% win rate. And in the end of the day, for me, all the indicators turned out to be BS. I wasted my time. Did I make some money with indicators? Yes. But in the end of the day, I lost more money with indicators. So in the end of the day, I was like, you know what? These things aren't working for me. They're just lagging. They're changing colors and the cross and the MACD and the Big Mac and the Daddy Mac or sorry, I couldn't help myself. But it's just like it wasn't happening. It just wasn't happening for me anymore. But why, right? So I think they don't work for me personally because they lag. And here's what I mean. Here, the indicator's telling you to go short, right? So you're short. But guess what? What happens when the market bottoms? The indicator is not going to tell you to go long here, right? But if you study price action, you'll know exactly that you would be looking to establish a support buy at this level. So you see that? Another problem with indicators. Remember, if you're new to trading, by the way, the market can only move three ways, okay? It could move up, which is classified normally as an uptrend. It could move down, which is normally classified as a downtrend. And then finally, it could move sideways, which is classified as a sideways moving market or a range. Ranges break out eventually. But you see here, look how much garbage you get when the market's moving sideways. See, a price action specialist doesn't need to worry about any of this crap because see, the market's moving sideways, 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 sideways. The indicator's telling you to buy, telling you to sell, telling you to buy, sell. Here, it's like all over the freaking place. So in my opinion, am I an indicator hater? I mean, pretty close, but no, I don't hate them. I just feel that you don't need them in my opinion. So now, let me show you why I think naked charts is the way to go. In the future, I'll make more videos about indicators. I'll do some paper trading with indicators so you could see the difference. We'll trade paper trade demonstrations, and then we'll do price action demonstrations on a demo account so you guys can see how much easier it is, in my opinion, to read the charts. Okay, so let's talk about how to set up your charts, no indicators. Let's get rid of this. All right, so let's start with a naked chart. This is the S&P 500, right? We'll use this as an example. This is the daily chart. Now, I like to use the daily charts because the time frame is very important. And the reason I believe is very important is because the big banks, the institutions, the hedge funds, right? The big dogs, right? The smart money, they're not looking at 1-minute charts. They're looking at the daily charts, okay? And a lot of these hedge funds watch the dailies, the weeklies. Now you could definitely trade 5-minute charts on a day trading and all that, but you still want to watch the daily charts. You want to know the long-term view on the market, right? Okay, so here we go. Here's a daily chart. And for those who are new to trading, every candle represents 1 day, okay? So this is about usually on a daily chart, you could get about a year worth of data, right? So here we are, 2026, right? And as we see, S&P 500, 2025 to where we are now, right? Almost, close to a year or whatever, right? All right, what comes next? So the first thing I like to do is find the most significant high and the most significant low of the market. This is, in my opinion, the best chart setup you could do. So where is the most significant low, right? Well, if we look close, these are all candlesticks, right? Each candlestick represents 1 day of trading. The most significant low, I mean, just looking at the chart, I can see it's right here. And why is that the most significant low? Pretty simple. It's the lowest low on the chart, okay? It's the lowest low on the chart. I mean, look, we're going all the way back here to October. Here was a low, but this low right here, this was the bottom. This is the low you want that is the most significant. So let's put it on there. Take a line, bam, there you go. Let's make it white. Let's make it a little thicker, right? Okay, perfect. What's next? Next, we want the most significant high of the market. Why? Because the most significant high of the market is where the market is most likely to react. It's either going to stall, it's going to pause, or it's going to break through. The market does one of three things when it approaches significant support and resistance levels. It can pause, it could break through, or it could reverse. Pause, break through, reverse. Always remember that. So where's the most significant high? Look at it right here. The all-time high. There you go. June 2nd, sorry, 2026. It touched it again last week, right? June 15th. So why is it the most significant high? Because look, if I go all the way back in time, there's no high on the chart, right? This used to be the most significant high. You see this level right here? This one, that used to be it, right? But then the market broke through. Boom, made a new high, made a new low. This is what we watch, right? So the most significant high right now is right here. 76, what is this? 76.53. Bam, there we go. That is the most significant high. So why do we want to watch that level? Because it's gonna determine whether we're gonna buy or sell, right? Depending on what the market looks like, right? Okay, so we got most significant low for the year, most significant high for the year. What's next? Next is the midpoint. Why? The middle point is called in Fibonacci, it's called the 50% retracement level. Why is this important? Well, for those who are new to trading, Fibonacci was like a mathematician, and he follows this. He discovered a sequence of numbers that repeats itself throughout life and history and all of that, and it's found in nature and it's found in economics as well. So basically, I'll do another video about this in the future, but his tool allows you to find. This is not an indicator, by the way. The Fibonacci is not an indicator, in my opinion. This is a tool. It's not an indicator. It's a tool that tells you levels that the market could react. And you want to know these levels because these levels are the most powerful thing in trading. So 1 year high, 1 year low, right? Middle point. Eventually, I'll make another video all about Fibonacci for you guys who are new to it. But basically, it takes the low of the year, the high of the year, adds them together, and divides it by 2. And that's how you get the 50% retracement level, which is right here, 69.95. So let's put that in there. We can remove the tool now. All right, so what's next? Now, actually, if you want to keep the tool up, you can. We'll go back to that later. But so Fibonacci states that markets normally trace 50% of its last big move. And this is important. This is a part of technical analysis that is very important, meaning if the market has a huge move like this, it will normally retrace back here eventually. Maybe not right away, but eventually, right? Same thing, if it has a huge move down, it will retrace 50% of its last move. All right, what's next? Next, in my opinion, you want to find where is the trend? Where is the trend in the market, right? Now you could do this a couple ways. You could drop down to a 4-hour chart. If you're a day trader, you still want to look at the daily chart, but let's just drop to a 4-hour here, for example. And what I want to do is learn how to draw trend lines. If you're new to trends, basically you can think of this as kind of like finding the momentum in the market, right? So if the market is trending upwards, we have what's called an uptrend, and we learn how to draw a line representing that. Okay, so that's one thing you could do. You could learn to draw trend lines. We'll take this off for now to make it easier. But what's next? Next, you want to find support and resistance. These are going to be your buy and sell zones. So how do you do that? And this is why you don't need indicators. So to find support and resistance, you're looking for the floor and the ceiling in the market. Now, if you're new to trading, it's going to take you practice. But basically, a ceiling is a level that the market can't break through. A floor is a level that the market can't break through. So looking at this chart, where do you see the floor? Well, if we look close, I see a floor right here. Why? Because look, the market, right? It tested that level. See how it tested it? Back away, rallies off the level. That creates the floor. So the floor is 72.32. What does that mean? I'll tell you what that means. It means that if the market approaches 72.32 again, you want to be a buyer. It's that simple. You want to be a buyer. Now, if I'm on a 5-minute chart, it doesn't matter. If I'm day trading, right? I drop to the 5-minute. Where's the floor, right? So the floor, we know, is 72.32, right? So even if it let's say this was the floor, right? This level here, and I want to do a day trade instead of a swing trade, 74.71, I could drop to the 5-minute, right? See the floor, right? And I could put an order right there at the floor. Now, of course, we need a stop loss. Well, for your stop loss, you could put it somewhere where you believe it will not get stopped out. What I like to do is use another support and resistance level. So there's two ways you could trade this, right? Support and resistance. If you're doing a swing trade, okay, like let's say you're working a job, you don't have time to watch the market all day long, you don't have time to stare at 1-minute charts all day long with indicators. You're working a job, you could put an order right here, 72.32. Okay, it's called an entry order. Place your stop loss under this low right here. Why that low? Because that low represents another floor. You see it? When we zoom in, you see how the market touched that price. Price creates the floor. Remember that. Price creates the floor. That price, 71.94, created a floor. Market backs off the floor, creates a level of support, right? Or protection, right? So if I place my buy order right here, I go to sleep, and I place my buy order right here, and I put my stop loss behind the floor, the second floor, not this floor, that floor. Risk 52 points. Okay, now I go to sleep, my order gets executed, I go to work the next day. Where do I get out? Great question. You don't need an indicator to tell you where to get out. Where you want to get out is where's the ceiling? Where is the ceiling? Resistance is known as the ceiling. So, same concept. Instead of looking for a floor, you're looking for a ceiling. Where is the ceiling right here on this chart? Okay, let's look. I see a ceiling right here. See that ceiling? 74.89. Why? Why is that the ceiling? I'll tell you why. Because look, if I draw a line right there, you could see the price tested that level and backed away. You always want to wait. If you're trading the daily charts, you always want to wait for the close, meaning if you're trading the daily charts, don't trade at 9:30 in the morning, don't trade at 3 p.m. Wait till the market closes at 4 p.m. to see what the market did. If you see the market hits that level and backs away, you know that that's a level the market can't break, at least not yet. So if I'm buying here and my stop loss is here, like this, let's do this trade right now as a paper trade just to kind of give you guys a better understanding maybe. All right, so here's my trade, right? I'm setting my order right here at support. I'm putting my stop loss right here, right? It's telling me I'm risking, well, this is the big contract, 2,000. Well, whatever. If you're using the micros, it'll be 200. But anyways, whatever, we're risking 2,000 here, right? There's my floor, okay? And where's my take profit? Right at resistance up here. Why? Because we know that the market, when it approaches this level, 74, 78, right? We know that it's most likely going to do one of three things. What does the market do when it approaches new floors and ceilings? One of three things. Pause, smash through, or reverse. Do we care? No. We just want to get out as soon as it hits that level. Don't wait to find out if it breaks through. Don't be greedy. Don't wait to find out if it's going to reverse. Don't wait to find out if it's going to pause. Just get out. Get out. Meaning you're buying here, your protect loss is here. You're risking 2,000 to make 12,000. This is like 10 to 1. Okay? I mean, that's a freaking home run trade right there. And again, you don't have to go for 10 to 1. You could go for a shorter resistance level, like this one here, if you want to be more conservative. That's still like, 5 to 1, whatever, right? And that's it. That's how you do it. That is the way you trade without indicators. Support and resistance, Fibonacci, trend lines, which we didn't get to because, we didn't, I'm not going to explain everything in one video. I'm going to make multiple videos about it, but I hope that gives some of you guys an understanding. Same thing, if you're on the 5-minute chart, it doesn't really change. You're just trading a shorter time frame now. Look for the ceiling right there. Look for the floor right here, right? So now I know, and then eventually you want to learn to find the trend, which we'll talk about in another video. This is a sideways moving market, so there's different things you could do with that as well. But basically I just wanted to, for those especially who are new to trading, who are struggling with these indicators, again, you don't need indicators to trade, guys. I mean, if you're using indicators and they really make you happy, continue to trade with them. If you love indicators, continue to, use them to your advantage. But in my opinion, when I started trading with price action, support and resistance, I started getting a clear understanding of how the market reacts at different levels. And eventually, the next video, we'll talk about Fibonacci. I'll go over this tool right here, and we'll talk about these zones. There's different zones for Fibonacci. I talked about the 50% retracement zone, but there's also a 61% retracement, a 78% retracement, a 38% retracement, 23%, and the market reacts at these levels. So you could also use Fibonacci as a way to find levels. Whether you're on the same thing on the 5-minute, you just measure the move smaller. But we'll talk about that in the next video. But for now, hopefully that helps some of you who are new to trading without indicators. And if you like the video, feel free to like, subscribe, put your comments below. Look forward to seeing all of you guys in the next one. And as always, my friends, never risk more than 1 to 2% of your account on any given trade. And always expect the unexpected when you enter the market. Have a great trading week, guys.